There's this moment in history that almost nobody talks about anymore, and it's probably the closest thing we've ever seen to what might be unfolding right now with the US dollar, crypto, and $37 trillion in debt. I'm talking about what happened in 1494, when Spain was sitting on a mountain of debt after funding decades of war, and they stumbled onto a solution so audacious that it literally changed the global financial system overnight. But I'm getting ahead of myself here. Let me back up and tell you why this matters to you right now. My name is David, and I spend way too much time thinking about money and psychology. If you're someone who looks at the headlines about national debt and crypto regulation and wonders what the hell is actually happening behind the scenes, and you're tired of surface level explanations that don't connect the dots, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact mechanism that massive governments use to escape debt traps without technically defaulting, and how cryptocurrency might be playing a role in the latest version of this playbook that financial institutions really don't want you connecting together in your mind. So let me take you back to Spain in the 1400s, because what happened then is the blueprint for what might be happening right now. Here's the thing. In 1494, the Spanish crown was drowning in debt. They had borrowed heavily from Italian bankers, from wealthy merchants, from anyone who would lend them money to fund wars against the Moors and finance various military campaigns across Europe. The debt had grown to the point where the interest payments alone were consuming nearly 40% of all royal revenue. Sound familiar? Now, the Spanish monarchs, Ferdinand and Isabella, had a problem. They couldn't raise taxes much higher without risking rebellion. They couldn't cut spending because they needed their military to maintain control. And they absolutely could not default because that would mean losing access to future credit and probably their heads. But here's the catch. Just 2 years earlier, in 1492, Christopher Columbus had returned from his first voyage to the Americas. And while most history books focus on the discovery itself, what really matters for our story is what happened next. Spain suddenly had access to something the world had never seen before at this scale: gold. Massive quantities of gold and silver flowing in from the New World. Now, you might be thinking, great, they found gold, they paid off their debts, end of story. But that's not what happened, not even close. Because Spain did something way more clever and way more devastating to everyone who had lent them money. Step one was simple. They took the gold and silver flowing in from the Americas and they started minting massive quantities of new coins. Step two, they used these coins to pay off their debts at face value. Sounds reasonable, right? But here's step three. They kept bringing in more and more precious metals and minting more and more coins, way more than the economy needed. And step four, this is where it gets really interesting. The massive increase in the money supply caused inflation to skyrocket across Europe over the next century. The price revolution, as historians call it, saw prices increase by roughly 400% between 1500 and 1600. What does this mean? It means that if you were an Italian banker who lent Spain 100,000 ducats in 1490 and Spain paid you back 100,000 ducats in 1520, you technically got your money back. You couldn't accuse them of default. But those ducats now bought you maybe a quarter of what they could buy 30 years earlier. Spain had effectively reduced their debt burden by 75% without defaulting on a single loan. Why would they do this? Because it's the perfect escape hatch. You maintain your credit rating internationally, you don't face the immediate political consequences of default, but you transfer the pain onto your creditors through inflation instead of through missed payments. It's default by debasement instead of default by declaration. In the decades that followed, wealthy creditors who had financed the Spanish crown watched their real wealth evaporate. The merchants who had lent money expecting a solid return found themselves holding coins that couldn't buy half of what they expected. Meanwhile, Spain continued to import gold and silver, continued to mint currency, and continued to spend like the debt didn't matter, because in real terms, it didn't anymore. And here's the kicker. The people who really profited were not the Spanish crown in the long run, because they squandered their advantage through continued wars and poor economic policy. The real winners were the new merchant classes who understood what was happening and shifted their wealth into hard assets land, and productive businesses instead of holding currency or debt instruments. The losers were the creditor class, the people who thought they were being smart by lending to a major government and holding paper promises. By the time 1600 rolled around, Spain's debt in nominal terms looked manageable. But the entire European financial system had been transformed by inflation. The wealth transfer was complete. So what does this have to do with $37 trillion in US debt and cryptocurrency? Everything. Just like Spanish monarchs profited from a new source of monetary expansion that let them inflate away their debts, there's a growing theory that the United States is setting up a similar play using a modern version of the same mechanism. And just like in the 1500s, most people holding the debt won't realize what happened until it's too late. Now, let me give you an everyday equivalent to make this crystal clear. Imagine you owe $300,000 on your mortgage. You've got a good job, you're making payments, but it's tight. Now imagine that overnight, your salary increases to 10 times what it was. You're now making, instead of say, $80,000 a year, you're making $800,000 a year. Suddenly that $300,000 mortgage is nothing. You could pay it off in less than 6 months if you wanted to. But here's the thing. All your neighbors' salaries also increased by 10 times. And the price of groceries, gas, your property taxes, everything else increased by 10 times too. Your mortgage debt became easier to handle, but you're not actually richer. The people who got screwed in this scenario are the ones who lent you that $300,000 at a fixed interest rate, because now they're getting paid back in money that buys way less than when they made the loan. This is exactly what happens when a government inflates its currency. The nominal debt stays the same. $300,000 is still $300,000. $37 trillion is still $37 trillion. But the real burden of that debt shrinks dramatically if the money supply expands and prices rise across the economy. Now, here's where cryptocurrency enters the picture. And this is what Anton Kobakov, Putin's senior economic advisor, laid out at the Eastern Economic Forum. Kobakov has been architecting Russia's economic strategy since 2012, navigating sanctions, building alternative payment systems, and studying exactly how the US maintains its financial dominance. He's not some random talking head. He's a guy whose job is to understand and counter American economic power. And his theory is that the United States is preparing to use cryptocurrency as part of a massive debt reset strategy. Most people heard this and immediately dismissed it as propaganda, some conspiracy theory from a geopolitical rival trying to undermine confidence in the dollar. But before you write it off, let me show you why this theory has some extremely uncomfortable evidence behind it. The United States currently has over $37 trillion in debt. That number grows by roughly $1 trillion every 100 days at the current pace. The government now spends over $1 trillion per year just on interest payments alone. That's more than the defense budget, that's more than Medicare, and here's the critical part. They can't cut spending significantly without political suicide. They can't raise taxes enough to cover the gap without tanking the economy. So what options are left? Traditionally, there are only a few ways out of a debt spiral like this. Option 1, you grow your economy fast enough that your debt to GDP ratio improves. But US growth is not anywhere near fast enough to outpace debt accumulation. Option 2, you default outright. But that would collapse the dollar's reserve currency status and destroy American financial hegemony overnight. Option 3, you inflate the debt away by expanding the money supply, making the nominal debt easier to service, but destroying the real value of the currency. For decades, option 3 has been the playbook. Print more dollars, keep interest rates low, let inflation gradually erode the real burden of debt. But there's a problem with that strategy now. Foreign creditors have caught on. China's been dumping US treasuries. Japan's been selling. Foreign buyers are walking away because they've realized they're on the losing end of the inflation trade. So the United States faces a new problem. How do you inflate away your debt when your creditors are refusing to keep lending to you? This is where it gets really interesting. Because Kobakov's theory suggests the answer involves creating a new asset class that the government can effectively control and manipulate to generate the monetary expansion they need. And that asset class is cryptocurrency. Now you're asking yourself, wait, how does crypto help the US government inflate away debt? Isn't crypto supposed to be decentralized and outside government control? And that's exactly the psychological trick that makes this so effective. Here's the mechanism. The US government, through various agencies and initiatives, has been quietly accumulating Bitcoin and other cryptocurrencies. Some through seizures from criminal enterprises, some through other means. At the same time, regulatory frameworks are being built that will eventually allow cryptocurrencies to be integrated into the traditional financial system in a controlled way. Not banned, not fully free, but regulated and tracked. The theory goes like this. Step 1, establish legitimacy. Get institutional investors comfortable with crypto. Let BlackRock and Fidelity launch Bitcoin ETFs. Let the narrative shift from crypto is for criminals to crypto is digital gold. This has already happened. We're watching it happen right now. Step 2, integrate crypto into the financial system. Create regulatory clarity that allows pensions, retirement funds, and mainstream investors to allocate portions of their portfolios to cryptocurrency. Make it easy, make it normal, make it feel safe. This is underway. Step 3, and this is the key. Use crypto as a monetary expansion tool. Here's how. The US government holds a significant amount of Bitcoin and other cryptocurrencies. As the price of these assets rises due to institutional adoption and increased demand, the government's balance sheet improves. They're sitting on assets that are appreciating dramatically. At some point, the government could theoretically begin using these appreciated crypto assets as a backing or justification for monetary expansion. Not exactly like the gold standard, but something adjacent. We have X billion in digital assets. Therefore, we can expand the money supply or issue new debt instruments backed by this digital collateral. But here's the catch. Unlike physical gold that has industrial uses and a relatively stable supply increase, cryptocurrency values are wildly volatile and heavily influenced by speculation, regulation, and market manipulation. The government and large institutions have enormous power to move these markets through regulatory decisions, public statements, and direct buying or selling. Step 4, execute the reset. Once crypto is deeply integrated into the financial system and the government holds substantial positions, they can orchestrate a scenario where traditional debt is restructured or revalued in relation to digital assets. Maybe they issue a new form of treasury security backed partially by crypto holdings. Maybe they use appreciated crypto assets to pay down portions of debt at favorable conversion rates. Maybe they create a scenario where inflation, in traditional currency terms, is offset by gains in crypto holdings, making the real debt burden manageable. And the beautiful part, from the government's perspective, is that creditors can't really complain. They weren't defaulted on in the traditional sense. The system didn't collapse. It just transformed. And by the time creditors realize that the dollars they're being repaid with have been devalued through monetary expansion justified by volatile digital assets, it's too late. The wealth transfer is complete. Now, you might be thinking this sounds insane, like some elaborate financial conspiracy theory. But let's look at what's actually happening right now in 2024 and 2025. The US government has been seizing and accumulating Bitcoin for years. Estimates suggest they hold over 200,000 Bitcoin, worth potentially over $20 billion, depending on market prices. That's not a conspiracy. That's public information from asset forfeitures. Regulatory frameworks for crypto are being built rapidly, with the SEC and other agencies creating pathways for institutional involvement rather than outright bans. BlackRock, the world's largest asset manager with over 10 trillion in assets, launched a Bitcoin ETF that saw record inflows. Major financial institutions that spent years calling Bitcoin a scam are now offering crypto services to clients. Meanwhile, foreign creditors continue to reduce their holdings of US debt. China's treasury holdings have dropped from over $1 trillion to under $800 billion. Japan has been selling. The typical buyers of US debt are backing away. At the same time, the national debt continues its parabolic rise, adding $1 trillion roughly every 100 days. Interest payments have exceeded $1 trillion annually. The situation is mathematically unsustainable under traditional frameworks. So we have a government sitting on billions in appreciating crypto assets, building regulatory infrastructure to legitimize and integrate those assets into mainstream finance, facing a debt crisis that can't be solved through traditional means, and dealing with creditors who are walking away from dollar-denominated debt. Does it prove Kobikov's theory? No. But it creates a pattern that looks uncomfortably similar to historical debt escape mechanisms. Let me tell you about another parallel that makes this even clearer. In 1971, President Nixon faced a similar problem. The US had promised foreign governments they could exchange dollars for gold at $35 per ounce under the Bretton Woods system. But America had printed way more dollars than they had gold to back them. France, Germany, and other countries started actually asking for their gold. The US was about to run out. Nixon's solution? He closed the gold window. Just announced that dollars could no longer be converted to gold. Effectively, he defaulted on the promise that gave the dollar its value. But he didn't call it a default. He called it suspending convertibility. And because the US was powerful enough economically and militarily, the world had no choice but to accept the new reality. The dollar remained the reserve currency, now backed by nothing except faith in the US government. Foreign governments and central banks that had accumulated dollars expecting to convert them to gold were left holding paper. The US had escaped its gold obligations without technically defaulting. The wealth transfer was complete. The dollar devalued against hard assets over the following decades, exactly as you'd expect when you remove the backing. What happened after 1971? Inflation exploded. The 1970s saw double-digit inflation rates. Oil prices quadrupled. The real value of dollar-denominated debt held by creditors evaporated. The US debt burden became manageable again, not because they paid it off, but because they inflated it away. The people who won were those who understood the shift and moved wealth into hard assets, real estate, commodities, productive businesses. The people who lost were those who held cash and bonds, trusting that the government would maintain the value of the currency. Now, does the current situation with crypto represent a similar pivotal moment? The mechanism is different, the asset is different, but the underlying pattern is identical. A government facing unsustainable debt, creditors losing confidence, a new asset class being positioned as a solution, and a pathway to monetary expansion that avoids the political cost of outright default. The antagonist in this story isn't some shadowy conspiracy. It's not even necessarily evil. It's the predictable behavior of any entity, government or otherwise, that has the power to change the rules of the game when those rules become inconvenient. The United States government benefits enormously from being able to print the world's reserve currency. That privilege allows deficit spending that would destroy any other nation's economy. But that privilege only works as long as creditors keep accepting dollars. When creditors start walking away, the government needs a new mechanism to maintain monetary expansion without losing credibility. Cryptocurrency, ironically created as a decentralized alternative to government money, might be getting co-opted as the tool that extends dollar dominance for another generation. The motive is simple: survival of the system. The $37 trillion debt is not payable under any realistic scenario using traditional methods. Growth won't solve it. Tax increases won't solve it. Spending cuts won't happen at the necessary scale. That leaves inflation and creative restructuring as the only options. And crypto provides the perfect narrative for creative restructuring. Why? Because crypto is new enough that most people don't understand it. It's volatile enough that price swings can be explained away as market forces. It's digital enough that it feels modern and inevitable. And it's gotten just enough mainstream legitimacy that institutional money is flowing in without people asking hard questions about what happens when governments hold enormous positions in supposedly decentralized assets. The method for hiding this is brilliant because it doesn't require hiding at all. It happens in plain sight, justified by market innovation and technological progress. When the government accumulates crypto through seizures, it's law enforcement doing its job. When regulators create frameworks for institutional crypto adoption, it's bringing order to a chaotic market. When pension funds start allocating to Bitcoin, it's diversification and modern portfolio theory. When the government potentially uses crypto holdings to justify monetary policy, it will be presented as forward-thinking economic management. None of these steps individually looks like a conspiracy. Together, they create the infrastructure for a debt reset that transfers wealth from creditors to the debtor, from savers to the government, from those holding currency to those holding hard assets. And here's the emotional reframe you need to understand. You are not a helpless victim in this scenario. You're also not going to stop this if it's actually happening. Governments have been playing these games for literally centuries. What you can do is recognize the pattern, understand the incentives, and position yourself accordingly. If the theory is correct, and that's still an if, the people who get hurt are those holding cash and traditional bonds expecting stable returns. The people who benefit are those who understand that currency debasement is the escape hatch and position themselves in assets that maintain real value during monetary expansion. So what do you actually do with this information? Here's where we shift from analysis to action, because understanding the game is useless if you don't adjust your strategy. Action step 1, and this is something you can check today. Look at the actual composition of your wealth. How much of your net worth is in dollar-denominated cash or bonds versus hard assets and productive investments? If you're sitting on a pile of cash in a savings account earning 4% while inflation runs higher, you're on the wrong side of the trade. I'm not telling you to dump everything into crypto or gold, but you need to understand that holding currency during a potential debt reset is like being the Italian banker lending to Spain in 1495. You might get your nominal money back, but the real value could be devastated. Most people have heard the advice to diversify a million times, so I'm not going to waste your time repeating that basic concept. What I'm telling you specifically is to look at your portfolio through the lens of monetary debasement. Ask yourself, if the dollar loses 30% of its purchasing power over the next 5 years, what happens to each of my holdings? Cash loses 30%, bonds paying fixed rates lose real value, real estate, productive businesses, scarce assets, those tend to maintain or increase real value during currency debasement. Now, here's something most financial advisors won't tell you because it complicates their fee structure. You need to distinguish between nominal returns and real returns. If your portfolio goes up 8%, but inflation is running at 7%, your real return is 1%. You're barely keeping pace. During periods of monetary expansion and debt reset, this gap widens dramatically. You can see your account balance go up and still be getting poorer in real terms. Check this specific thing today. Look at your retirement accounts, your 401k, your IRA, whatever you have. What percentage is in bond funds or stable value funds? Those are the holdings most at risk if we enter a period of sustained higher inflation or monetary debasement. I'm not saying sell everything tomorrow, but you need to understand the risk you're taking by holding those positions. Here's the second action step, and this one's more offensive. Start thinking about debt differently. In an inflationary environment, fixed rate debt becomes your friend, not your enemy. If you lock in a mortgage at 4% and inflation runs at 6%, the bank is effectively paying you to borrow money in real terms. The dollars you pay back are worth less than the dollars you borrowed. This is the same play the government is making at a massive scale. They're borrowing in today's dollars and will pay back in tomorrow's devalued dollars. You can do a smaller version of the same thing. Obviously, don't go crazy and leverage yourself into oblivion, but understand that the conventional wisdom of paying off all debt as fast as possible might not be optimal if we're entering a period of currency debasement. Specifically, look at your mortgage if you have one. If you've got a low fixed rate, maybe below 5%, paying that off early might actually be a bad financial move if inflation stays elevated. The same dollars you'd use to pay down that mortgage could be deployed into assets that appreciate with inflation, like real estate, businesses, or scarce commodities. You're essentially borrowing at a low fixed rate to invest in inflation-protected assets. That's a wealth-building strategy, not a debt trap. Now, the third action step, and this is where it gets psychologically difficult. You need to become comfortable with a level of uncertainty that most people can't handle. If this debt reset theory is correct, we're in a transition period where the old rules are breaking down, but the new rules aren't fully established yet. That creates volatility. It creates confusion. It creates opportunities. The people who win during these transitions are not the ones who have perfect information or who guess right on every trade. They're the ones who understand the underlying forces, maintain flexibility, and don't panic when the market does something unexpected. That means holding a diversified mix of assets, keeping some dry powder for opportunities, and not being so heavily positioned in any one outcome that you're destroyed if you're wrong. Specifically, this means you should have exposure to multiple scenarios. Some traditional stocks and bonds in case the system muddles through without major disruption. Some hard assets and commodities in case inflation accelerates. Some cash or short-term treasuries in case there's a deflationary crash that creates buying opportunities. Maybe even some exposure to cryptocurrency if you believe it plays a role in the next financial system, but not so much that you're wiped out if it goes to zero. The point is not to make a single massive bet. The point is to position yourself so that you benefit regardless of which specific path this debt situation takes. That's not sexy. It's not going to make you a millionaire overnight, but it's how you actually preserve and build wealth during periods of financial system transition. Here's the fourth action, and this one's about information flow. You need to pay attention to what governments and central banks actually do, not what they say. The Federal Reserve will tell you inflation is transitory right up until the moment they admit it's not. The Treasury will tell you the debt is manageable right up until they need to restructure it. You cannot rely on official statements to give you advance warning. Instead, watch the actions. Are foreign central banks buying or selling US Treasuries? That tells you what they really think about dollar stability. Are major financial institutions increasing or decreasing their crypto holdings? That tells you whether they believe digital assets are part of the future financial system. Is the government creating regulatory pathways for crypto integration or trying to ban it? That tells you whether they see it as a threat or a tool. You can find this information. It's public. Foreign treasury holdings are reported. Institutional crypto positions are often disclosed. Regulatory proposals are published. Most people don't look at this data because it's boring and technical. But that data tells you what the smart money is actually doing, not what they're saying in press releases. Set up a simple system. Maybe once a month, spend 30 minutes checking foreign treasury holdings, looking at institutional crypto flows, reading the actual text of major regulatory proposals. You don't need to become an expert. You just need to track the trend. Is foreign demand for US debt increasing or decreasing? Is institutional money flowing into or out of crypto? Are regulations tightening or loosening? Those trends tell you whether the debt reset theory is playing out or not. And here's the final action step, the one that might be most important. Change your relationship with financial authority. Stop assuming that governments, central banks, or major financial institutions have your best interests at heart. They don't. They have their own interests. Sometimes those align with yours, often they don't. The US government's interest is to maintain its ability to spend and service debt without political consequences. Your interest is to preserve and grow your wealth. Those are not the same thing. In fact, they're often directly opposed. If the government inflates away its debt, that makes their balance sheet look better, but it makes your savings worth less. Understanding this isn't cynical or paranoid. It's just realistic. Every entity acts in its own interest. The government will use the tools available to manage its debt burden. Those tools include inflation, monetary expansion, and financial system restructuring. If you're positioned as a creditor to the government, holding cash and bonds, you're on the other side of that trade. The psychological shift you need to make is from trusting the system to understanding the system. The system isn't evil, it's just operating according to incentives. Your job is to understand those incentives and position yourself accordingly. So let me bring this full circle. Spain in the 1400s found gold and used it to inflate away debt while technically honoring their obligations. The United States in 1971 closed the gold window and inflated away debt while maintaining reserve currency status. Now, in 2025, we might be watching the setup for another version of the same play, this time using cryptocurrency as part of the mechanism. Is it certain? No. Kobakov could be wrong. This could all be coincidence and market forces playing out naturally. But the pattern is there. The incentives are there. The mechanism is being built in real time. And the historical precedent shows us that governments facing unsustainable debt loads will use whatever tools they have to escape the trap without calling it default. Your job is not to predict the future with certainty. Your job is to recognize the possibilities, understand the risks, and position yourself so you're not destroyed if the worst case happens and you still benefit if things work out better than expected. That means diversification across asset classes, understanding the difference between nominal and real returns, being strategic about debt, watching what institutions actually do rather than what they say, and fundamentally shifting your mindset from trusting authority to understanding incentives. The people who build real wealth over decades are not the ones who make perfect predictions. They're the ones who understand the game being played, recognize when the rules are changing, and adjust their strategy accordingly. Right now, the rules around debt, currency, and the financial system are potentially changing in a significant way. Whether it unfolds exactly as Kobakov described or takes a different path, the underlying forces of unsustainable debt and the need for monetary expansion are real. You can ignore that reality and hope everything works out. Or you can take the information, verify it against what's actually happening in markets and policy, adjust your positioning, and give yourself the best chance to preserve and grow wealth regardless of which path this takes. The choice, as always, is yours. But now at least you understand the pattern, the history, and the possibility.